Hello and welcome to week 3 of Tourism Numbers. My name's Andrew Pearce and today I want to take you through demystifying some of the numbers in tourism. For most of you running a small business, you probably have your finger on your business pulse. You can probably tell whether you're making a profit or going to survive simply based on the cash balance or the number of people coming through your door each day. This has been thrown out a little bit of recent, and so I want to take you through some of the basics behind our financial numbers to give you a better indicator moving forward. To summarise what we'll run through today, we want to go through where the value really is in our numbers, which reports and how do we read them, why budget and how to build one, the activity drivers, seasonality and break-even points, and the importance of reporting regularly. So let's get into it. So firstly, what is the value in numbers? Is it simply to appease the taxman? Well, let's think about it. If you wanted to value your business, you'd need to know the numbers. If you wanted to sell your business, you need to know the numbers. If you need to refinance your business or buy new capital expenditure items, then the numbers are really important. And likewise, if you want to grow and expand your enterprise, you need to understand the numbers, as well as if you want to minimise some tax. So when it comes to understanding your numbers and why is it so important, it can be confusing because there are so many different ways of representing our numbers. So let's start with the 3 most common sets of numbers that you're probably aware of: the profit and loss statement, the balance sheet, and a cash flow forecast. So let's start with the profit and loss statement. You may have heard of the old adage that turnover is vanity, profit is sanity, and cash is king, or cash is reality. This is referencing the profit and loss statement. So the profit and loss statement is really telling us if we're making money. Some of us may use our bank account to tell us this, but it's not necessarily the best indicator. And we'll talk about cash versus accruals accounting briefly in just a moment. But firstly, what is on a profit and loss statement? We have our sales line, followed by direct costs. The direct costs are the costs that we really can't do without to make a sale. So if we're talking about a food and beverage business, it's going to be the purchase of the food and drink that we're selling. If we're talking about an accommodation business, it could be some of the booking site charges or the cleaning costs associated with your rooms, or refreshing the minibar, for example. That gives us the gross profit line. And under the gross profit line, we take away our indirect costs or our general expenses. As you can see from here, it's everything from the accounting fees, the advertising, the rent possibly, and wages. Sometimes wages is a direct cost as well, don't forget, and sometimes it is an indirect cost. You will also see depreciation on a profit and loss. It's not something you would necessarily put in. Your accountant might do it for you before lodging your tax return. This really represents a portion of the capital expenditure that you have. So for example, if you've bought a large item of equipment or a car or something like that, it really should go on the balance sheet, and then a portion of it is claimed over the effective life of that asset. What we've seen of recent, of course, is the announcement from the ATO to allow us to accelerate that depreciation and claim more of it sooner. In some cases, 100% of it in this year. Now, this can create a lot of noise on your profit and loss, and if you're trying to compare this year versus last year, for example, there's going to be some pretty big variances. So what I like to do is put the depreciation and those capital purchases right down the bottom below our net profit line, so we can actually compare our operational profit year on year and get a clearer picture of how we're really performing. You may have heard of the terminology EBITDA. It's like a net profit line. It stands for earnings before interest, tax, depreciation and amortisation. It's a great line for doing these comparisons, and after that we can take out the additional noise of the interest and the depreciation and the tax if your entity pays tax to see what we are really doing after everything. So timing is everything. And if we touch on the accruals versus cash accounting for just a moment, you're probably pretty familiar with cash accounting. It's very similar to following the movements in your bank account, the inflows and the outflows. But in reality, when we have inflows such as deposits, for example, it's not really income until somebody actually comes and stays and uses that service and uses that deposit. And likewise, if we had customers that didn't pay us on the spot, but instead were sent an account, the income is really when they stay with us, regardless of whether they've physically paid us or not. And a trade debtor or a receivable is actually listed in our balance sheet for eventual collection. The same can be said for some of our expenses. You might have expenses that you can buy where you don't have to pay the account for 14 or 30 days. It's very common in food and beverage, but it's very common across all businesses. Once again, in reality, the expense is really incurred when we buy the expenses, and then when we make a payment sometime down the track, it's really paying off the trade creditor or the payable. So there's two ways of looking at our profit and loss statement. A simple cash basis, which is really giving us a good understanding of our cash profit and loss, or we can look at it on an accruals basis and bring in those items which are not necessarily physically received or paid for yet in cash. With what we've gone through just recently with a bit of turmoil with COVID-19, some of us have got into a little bit of trouble if we haven't properly reflected things on an accruals basis. We've found that we may have to have refunded deposits, for example, or we've had to close our doors and we've still had expenses to pay after the fact. And sometimes it can be hard to determine what is your real profit position. Moving to an accruals basis will help with that. And if you're using common accounting software like Xero or MYOB or QuickBooks, the reports can be toggled between a cash basis and an accruals basis. It may be that you're lodging your business activity statements and even your income tax on a cash basis, but it doesn't hurt to get a better understanding of how things are working on an accruals basis so you can actually pinpoint exactly how you are going. So my final question here is, can you still go broke making a profit? And the answer is yes. Many businesses do, unfortunately, and it's because they run out of cash. On the profit and loss, you often don't have the big plant and equipment costs or loan repayments, for example. These are coming out of your bank account and can deplete your bank account below zero and send you broke even though you are making a profit. Once again, trying to understand things on an accruals basis will give you a better indication of how you're really travelling. So let's look at the balance sheet. Here I've posed the question, do we have enough reserves to cover our debts? Well, that's what the balance sheet is here to tell us. A lot of people don't look at their balance sheet in too much detail, but it can tell us a lot about our business. So let's just go through the basics to get a slightly better understanding of how it all works. So when we look at your balance sheet, it's made up of your assets and your liabilities, and it balances out to your equity, hence the reason it's called a balance sheet. If we run through the assets just quickly, it includes things like the cash sitting in your bank account. It could include stock on hand. It could include debtors, so the money that's owed to you by customers that haven't yet paid you. It will include plant and equipment and possibly goodwill. Your liabilities will include the trade creditors, the money you might still owe to your suppliers. It could have credit card balances, the ATO liabilities like GST, PAYG and superannuation owing on employees. It could even include provisions for things like income tax and annual leave for employees, and it will include bank loans, all loans to the partners and or the shareholders. Now, the assets minus liabilities will equal your equity, and the equity is really the retained profits in your business, or the profits that you may not have taken out of your business, and sometimes called partner funds, and it may also include the original funds that you contributed to your business to get it going. So once again, if we reference back to cash versus accruals accounting once again, if we are working on a cash basis, we often won't list our debtors and our creditors, for example, but if we're on an accruals basis, we will. The other thing that sometimes isn't reflected on the balance sheet when we're working on a cash basis is some of the provisions, or it might be that you wait till the end of the year for your accountant to update these provisions. But if we're keeping these things more up to date, we'll have a better indication at any point in time as to whether we are solvent, because the definition of solvent is making sure that we actually have positive net assets. Assets minus liabilities needs to be greater than zero. So my last question here is posing, what happens if you don't consider your accounting numbers? And the possibility really is that you could be flying blind. Once again, We probably only look at these balance sheets once a year after our accountants possibly produce them. They're usually produced on the 30th of June for your tax return, but usually it's sometimes afterwards before we even look at them. In reality, these are available at any point in time. If we're using accounting software, we can simply go to the reports section and bring up one of these balance sheets and see where we actually are at any point in time. All right, let's move on to the last one, which is the cash flow statement. Now, you may have seen a cash flow statement before, and I wouldn't blame you for glossing over. The cash flow statement is broken up into these three areas: the operating, the investing, and the personal activities. I find that it's far better to look at these in a graphical format, and for our clients, that's exactly what we do. They're always graphical. So let me just run through one here to give you a bit of an idea of how to understand one. The cash flow statement is really a combination of your profit and loss and your balance sheet put together. It tracks the opening balance of your bank account through to the closing bank account based on the movements of your profit and loss and your balance sheet. So what I've highlighted here in the yellow is the profit and loss section. So as you can see from this graph, we have a positive bank balance to open with at the start of the year. We've made a profit, and I've added back the depreciation and amortisation as well, because we don't write a cheque out for that. So we should have money in the bank if we've banked all our profits. But as you can see at the end of the year, the very end of that line, it's less than what it was to start with. So why is that? How could that be? Well, in this case, we can see that there are customers we've sent invoices to that haven't yet paid us. So the money's still sitting in our customers' bank accounts and not in ours. One of the areas there is the stock has had a negative effect on our bank balance. It might be because we've purchased additional stock and we've got money tied up in our stock on our floor, once again, rather than in our bank accounts. It may also be because we've had to pay a big income tax bill or catch up on some trade creditor accounts that weren't paid at the start of the year. It might be that we've bought new plant and equipment, and we may have made loan repayments. In this case, the loan is actually a positive, but we've had an inflow of cash because of that loan we've taken out. And the last line there is the personal activities. You can see where we've taken money out of the bank account by way of dividends or distributions perhaps. It's not the salary and wages because that's represented in our profit and loss. An important part here is that working capital section, our debtors and our creditors and our stock, or work in progress in some cases. It's important because that's where a lot of our cash does get tied up in our business. And even though we might be making a profit, if we're not getting the cash into our bank account, then we can go broke. So have you ever been told at the end of the year, you've made a profit, you've got all this tax to pay, and you're thinking, where is the cash? Hopefully this will give you a better understanding of where it's actually gone. Okay, let's move into budgets, forecasts, and profit plans. Essentially, they're all the same thing. Why is budgeting important? Well, it is a trend analysis based on your past or industry currently. It is a trend analysis based on your past or industry currently. It forces you to look at what is working and what isn't, so you can make effective changes to your business. It helps plan your expectations and timing for a profit and capital expenditure. So it picks up if you're overspending, especially around seasonality. Don't spend it while times are good and not leave some for when things are a little bit tighter. It gives you something to compare your actual performance to. So effectively it's a benchmark for hitting your goals and knowing whether you're on track or off track. It's a decision-making tool, which allows you to do some what-if scenario planning. Effectively, you get to understand the financial impact of your decisions before you make them. The banks love it, especially in the case of combining it with a balance sheet forecast and moving that to a cash flow forecast, which is what we call a three-way forecast. And lastly, it allows you some accountability and a delegation tool. So, for example, it might allow you to set a budget for maintenance, for example, and give that to somebody else to take charge of. The how, I'll cover off on a little bit more detail in a future slide. But as you can see from this diagram, it's pretty easy to simply go into your accounting software or last year's financial statements from your tax returns, scrub out the numbers and start writing in new ones. Once we've done our budget, we get to work out our likely break-even point. So budgeting allows you to get an expectation of this, and I think it's worthwhile starting on an annual basis and then breaking it down into a month-by-month basis. To do this, you'll need to understand your fixed versus your variable costs in your business and get an understanding of the different levers that you can pull to make the situation better, especially in those poorer months. Pricing also becomes really important here. It's one of those levers you can pull to make sure you're maximising profits when times are good and making up for the pitfalls of the poorer months. So let's look at break-even analysis. Once we've got our budget in place, we're able to work out our expected break-even point. So keeping above your break-even requires knowing your fixed versus your variable costs in your budget, understanding the different levers that you can pull, and predicting your winter lows versus your summer peaks and pricing for maximum profit. So what I like to do is start with an annual break-even analysis, work out where you need to be for the year to break even at least, and then you can start doing it on a month-by-month basis. You'll be able to work out from your seasonality which are the bad months versus the better months, and start looking at those different levers you can pull to make some of those months better. One of the levers that we can pull is around yield management, and David Reed's going to be running a masterclass on that specifically, so make sure you do tune in for that. Now let's look at the activity drivers in your business. This is really important for building out your budget. Activity drivers are the key performance indicators or the metrics, and they are different in every business and in every industry. So understanding yours is really important. On the slide here, I've used the example of accommodation business, and I'll take you through what we can influence and which ones are going to make the biggest difference in your business. So as you can see, this is an 8-room accommodation business. I've got each of the months displayed, and things like the number of rooms and the number of days in a month, of course, we can't do too much to influence unless it's a leap year or we're commissioning new rooms. But when it comes to the occupancy percentage, this is something we can look up the trend analysis for. There are benchmarking sites. Tourism Tas would have some information on this as well. But we can also find out from perhaps the people around us or your historical numbers. When it comes to the average rate per night, this is where you can play around quite a lot. And it might be dependent on whether you have a minimum night stay, for example, and provide some kind of an incentive for longer stays. An average rate is one that you probably can play around with quite a lot. You might have incentives there for minimum night stays, for example, and depending on the season, you're allowed to change that rate, of course, as well. Once again, yield management becomes really important here, so tune in for David's presentation on a few ideas of how you can get maximum profits in the best times. So which numbers count the most in your business? All right, let's move into how to actually build your budget now. So ideally, we build it from those activity drivers. And that's the problem with a profit and loss. Usually it starts at the revenue line item, but where does that figure come from? So if we've done our activity drivers session first, we can build our revenue up from that. We can represent your business plan assumptions in your numbers. So we go through each line of your profit and loss and each line of your balance sheet. We consider the capital expenditure or the changes in costs, and we just use sensible best guess estimates. And don't forget to get the ideas, as I mentioned before, from whether it's your industry bodies, your frenemies, it might be the person down the road, or people in your team, suppliers, customers. And the next thing you need to do is review this on a regular basis. So let's go into how we do that. So reporting or reviewing your numbers. I suggest this is something you need to be doing more than annually. Quarterly perhaps, monthly. In some cases you can do it more often than that. What it's going to tell us is if we're on track. And if we've got a budget that we're comparing to our actual numbers, then it's going to tell us a lot more. Which areas are working, which areas aren't, what are the actions that we can actually take to improve things before it's too late. It's no good looking at your numbers on an annual basis to find out things had been pretty poor and you'd let all those months go by doing the exact same thing when you could have been doing something to change it. Once again, there is accounting software out there, and as I mentioned before, you might be using some of it like Xero or MYOB or QuickBooks, and it will allow you to do some reports and give you some of the information you need to make some good decisions. But there are also some add-on softwares out there that allow you to dashboard some of these numbers. To mention a few, there'd be Spotlight Reporting, Futruli, Float is good for cash flow forecasts. And as you can see on the screen, a graphical picture of green if you're on track or red if you're not will give you faster insights and what you need to do. The one thing I will suggest is booking a time out in your diary and putting an agenda around what it is that you actually want to look at. The software will simply take away some of that prep time and hopefully make it a slightly more enjoyable experience. And also, discipline's important. So if you're doing it with a friend or a family member, tie them in or talk to your accountant or your business coach. So just to summarise this presentation, firstly, we talked about the value in numbers. The real value in understanding your numbers is bigger than just your cash balance or your profit. A profit and loss and balance sheet makes sense, especially when you're comparing it to your budget or your forecast. The activity drivers are key to working out what your revenue plan is going to be and knowing if you're on track or not. And make sure you diarise your reporting, a monthly review, and automate what you can with your software. My name's Andrew Pearce. Thank you for listening, and I hope I've added value to you.